Hi, everyone. I'm John Petrides. I'm a managing director with Point View Wealth Management. We're going to begin the webinar in about 30 seconds. We're just going to let a few more people wait till the queue builds up, and then we'll start. Okay, so why don't we begin? Thank you, everyone, for joining us today. My name is John Petrides. I'm a managing director and portfolio manager with Point View Wealth Management. Joining me today is Elaine Phipps, another portfolio manager within the firm. And today I think we have, as we continue our monthly webinar series, we have, I think, a very important webinar, very topical, given the volatility that we've seen in the market in May. We're talking about where there are certain sectors that if you look longer term and you get through the short-term volatility, where there are some investment opportunities that we're finding that we think are attractive today. So I'm going to turn it over to Elaine. For those of you that are new to the webinar series, we always like to start with an intro to Point View to give you an idea about our investment process, our philosophy, how we approach client portfolios, the services that we offer. So it gives you a better indication as to where we're coming from an investment standpoint and from a services standpoint. So let me now turn it over to Elaine to begin her portion of the presentation. Elaine?
Good morning. Thank you, John. Good morning, everyone. For those of you who are listening for the first time, I wanted to provide an overview of our firm, Point View Wealth Management. We were founded in 1993 by David Dietz, so that means we are in our 26th year of operation. Point View is registered with the Securities and Exchange Commission and is an independent fee-only advisor. So what that means is we don't charge or receive any commissions for recommending a particular product, stock, or trade. What we do very well is provide customized investment management. Our niche is families, individuals, small institutions, and nonprofit firms. We also believe in avoiding excess fees, which means that we limit the use of mutual funds in our portfolios and do not outsource investment management business. While we do charge a flat rate management fee, we don't believe in generating yet another level of fees for you by paying a mutual fund company to reimburse them. We specialize financial planning practice as well, headed by Claire Tove. She has a past life as a tax attorney, and she now specializes in knowing the tax law and estate planning. Point View works with clients on multiple scenarios to see where they stand financially in regards to goals such as funding college educations, starting a business, taking a large vacation, and ultimately retirement. Our model for clients involves reviewing and rebalancing their portfolios at least monthly or as market events dictate. We don't employ a set it and forget it philosophy. However, we do endeavor to not raise trading costs unnecessarily. We also believe clients' portfolios should be managed with tax efficiency in mind. It's not just what you make, but it's what you retain after paying the government its share. While taxes should never solely dictate the investment decision, there are more efficient ways to structure your portfolio and manage capital gains and losers. That is one of our top priorities here at Point View. In terms of account specifics, our minimum relationship size is $500,000. That includes all family accounts. It doesn't have to just be one individual account. We charge a flat fee of 1% annually for assets under management, and that's paid quarterly. And our financial planning services are included in this fee. As an additional measure of security and comfort for everyone, all of the assets we manage are custodied at Fidelity in the client's name. That means you can log on to the Fidelity website each day to see exactly what your account is doing. In terms of accolades, Point View has been ranked by CNBC as one of the top independent fee-only managers in the country. And last year, 2018, we received a similar award from Financial Advisor magazine. So that's an overview of the firm, and I think John is going to take it from here to discuss some of the industry sectors.
Thanks, Elaine. That was really helpful. Before we begin, I just want to call everyone's attention first to, there's a polling question. If you look off I think to the right, or may have seen the question already. I do see some people are answering. And if you look on the toolbar, there is a polling question that says, do you think the U.S. economy is headed into recession within the next 12 months? Interestingly, so far, 2/3 of you have said yes, and a third say no. So we'll keep an eye on that. We'll give you the results at the end. Also, there's a chat room where this is private, so no one else can see the question that you're asking. But please, we want this to be interactive. We'll do Q&A at the end of the call. So please type in your questions. If you're watching the replay of this, please send us an email. We'll give you our email address at the end, and send us any questions that you may or may not have. So let's begin. Obviously, despite the volatility that we've seen in May, and by the way, it was the worst May we've seen since 2012, and that idea of sell in May and go away has always been a popular phrase, but it hasn't held in nearly 7 or 8 years. The stock market's really gone off to a strong start. We've seen it in June, the last couple of days, with a bit of a rebound. And why is that? Well, I think perception has changed on many levels. In the fourth quarter, perception was that the U.S. economy was slowing. Maybe the global economy could head into recession led by a slowdown in China and increased tariffs. That had a ripple down effect as to what would happen with earnings. And at the same time, the Federal Reserve was increasing interest rates to finish out the year. So the market viewed that as the Fed pouring kerosene on the fire. And what you're seeing in today's market, or since the start of the year, is a complete reversal of that perception. First, the economic data coming in on the U.S. and the global economy is okay. It's not perfect, but it definitely doesn't signal recession. Company earnings, although coming off of a tough comp year over year from a growth rate, more than 75% of companies beat analyst expectations. And then finally, the Federal Reserve has really done an about face on interest rates, where they've moved from potentially raising rates 2 times for the year to moving into a patient and neutral role. And just yesterday, and part of the reason of why the market rallied yesterday was the Fed saying they will, reiterating they will do what needs to be done to keep the economy in growth mode, signaling the Fed could raise interest rates. So despite the near-term sell-off, we're still up 10%, if not more. So the question is, are stocks still attractive today? And you look at, where would you invest an incremental dollar today, to stocks, bonds, or cash? So what we do is, is the stock market attractive? And we go through this checklist of questions. What is the health of the U.S. and global economy? Well, by and large, it's okay. We're not in it's not too hot, not too cold. The question is, where are we headed? And, that really, and what the market is trying to figure out is what is going to be the impact on tariffs on the Chinese economy, and will the U.S. continue to tariff other nations, as we've seen with the threats on Mexico and potentially India. So right now, and looking forward, the economy is definitely not overheated, but the data is strong enough across the board to say that we're not in recessionary territory anytime soon. How are corporate earnings doing? Well, we had a tough comp year over year. Corporate earnings had been growing nearly 20% over the past couple of years on the back of, last year helping with the cut in the corporate tax rate. And this year, expectations were coming into this past quarter were for a negative 4% growth year over year, or a decline in earnings growth. And we actually finished about flat, with more than 75% of companies beating analyst expectations and another 5% or so meeting expectations. So it was, by and large, a pretty good earnings season. Corporate balance sheets, by and large, are pretty healthy. Companies, although there's been a spotlight on the amount of debt growing on corporate balance sheets, you have to look at the other side of the ledger and see that about 30% of the assets on companies in the S&P 500 are in cash. So on a net debt basis, by and large, companies have liquidity to service their debt. Are banks lending? The answer is yes. Corporate, commercial, and industrial loans are pretty good. Individuals have access to credit to buy homes and to do HELOCs. The car market the loans for cars have tightened a little bit. But by and large, the banks are out there lending because people have jobs. The unemployment rate is below 4%. Wages are growing north of 3%. And by and large, people feel pretty confident that they're out spending money despite, again, the volatility in the stock market. And this is, where are interest rates and where are they headed? Well, right now, the interest rate, the Fed funds rate is between about 2.25% to 2.5%. Interest rates on a 30-year fixed mortgage are now below 4%. So, the cost to borrow money, for those on the call that remember the late 70s, early 80s, when the cost to borrow money was double digits, from a historical standpoint, it's still pretty cheap. Companies can borrow money at cheap rates and get a high rate of return. So interest rates are not overly high. Where is inflation? Well, inflation has been dormant. Part of the reason why the Fed can now step to the side in terms of having to increase interest rates is that inflation has not met the Fed's expectations. The Fed was convinced that by now, with the amount of stimulus that they've been doing, that inflation would have been significantly higher than it is. But it's just not that much of an issue. We're between around 2% or so by and large. So, the economy is clearly not overheating, and the global economy is not overheating. So there's no inflationary pressures like we've seen, in the 70s. And how about valuations? Well, the stock market, the S&P 500 is trading at about 16.5 times forward earnings from a price to earnings multiple. So to put that in perspective, that's around a little bit more than where we've traded on average over the last 60 years. And coming out of the recession over the past 10 years, the market is traded about 15 times earnings. So a little bit of a premium. But it's not anywhere near where we were in 1999 when we were trading at 28 times earnings. And we're nowhere near where we were in the bottom of the crisis where we're trading at 10 times earnings. So valuations are by and large okay. And again, when you put it in the context of where interest rates are and where inflation is, and how corporate balance sheets are, and the fact that banks are lending, the environment is pretty good to invest in the stock market. Then you look at where are stocks relative to bonds and cash. Well, over the past 12 months, we've seen with short-term CDs and money market rates have increased, but you're still getting on a pre-tax basis around 1.5% to 2.5% return on your money. Now, on an after-tax basis, and on an inflation basis, your returns are going to be much lower. And cash, by and large, is an option. It's sort of a timing mechanism that maybe you need cash in the short term for a large purchase, or you're trying to get cute to time the market and put that cash to work. Which again, but over the long term, cash is not a viable option because your purchasing power will just get eroded because of inflationary costs and the cost of living. Right? So you have to put cash to work. Then you look at the bond market. Well, bonds last year in 2019, for the first 9 months of the year, a bond was a 4-letter word. With interest rates rising, no one wanted to own bonds because they thought that this was going to be it. Rising interest rates means lower bond prices, and if it wasn't for the volatility that we saw in the fourth quarter of 2000 of last year, the bond market would have had its first negative return in a very, very long time. So, but bonds finished flat because investors ran for the exits, ran for safety because the equity market got so volatile. Even today on the US 10-year, you're getting a below 2.2% return for 10 years. Again, on an after-tax, after-inflation basis, you're looking at a nearly 0% return for 10 years. Now, that doesn't mean that bonds shouldn't be a portion of your portfolio. As we've seen in the fourth quarter, bonds do provide stability, and the suspenders when the equity portion of the portfolio gets overly volatile. But again, if you look at the overall environment relative to bonds and cash, and the fact that interest rates are low, the Fed is on your side, stocks look pretty attractive. The only thing that's missing from the equation is some resolution on tariffs. But again, here we're not out of the woods. I don't want to sound Pollyannish that we think stocks are there can't be volatility. Obviously, if the trade war continues, nobody wins. There are issues and cracks in the EU. The Italian economy, the Italian banking system is under a lot of pressure. Italy's the third largest economy in the Eurozone. So, if Italy becomes like Greece did in 2011, that's going to be an issue for the European Union to deal with. Can companies continue to grow earnings? Well, clearly tariffs are going to pressure margins. We won't know this until July when companies start reporting earnings, how they're able to mitigate the tariff situation. But do companies have more gas in the tank to continue to push earnings higher outside of just buying back stock? A lot of people have questioned, well, we're due for a recession. We haven't had one in 10 years. So, it's just a matter of time before the cycle wears itself thin. And there's some truth to that. And again, time will play itself out. The caveat to that is that the Fed stands ready to jumpstart the economy if need be. We're not out of the woods from a geopolitical standpoint. Trump has been vocal with his dismay on Iran. Iran has been vocal back toward the U.S. So if there is growing tension there, we would expect to see a spike in oil prices, which obviously, if we're paying more at the pump, that doesn't help economic growth. I mentioned the corporate balance sheets. Jerome Powell, the chair Fed, mentioned then that he's keeping an eye on the level of corporate debt. Not worried yet, but although I think balance sheets by and large are doing okay, this is something that we have to monitor. And of course, the national debt. We're $21 trillion in debt and climbing. That's a lot. And there's no political will, and there hasn't been for a very long time in DC to focus on paying that down. This will come to roost, and with the baby boomers taking on more entitlements from Social Security and Medicare, this is only going to go up. So this at some point will become an issue for the global economy, but we're not there yet. Here's what we like to show you is, people say, oh, buy the market, right? Just buy the index fund. But I think it's important to lift up the hood and see what the index fund is made of. And this is, as of April 30th, this shows you the sector breakdown of the S&P 500. And by and large, this hasn't changed all that much through the end of May. We're waiting for those results. And you can see technology is 21% of the index. Now, the S&P had reshuffled its sector classifications back in October, and it removed Facebook and Alphabet, Google, from the tech sector and put them into communication services. Basically, they consolidated AT&T, Verizon, companies like Netflix in with Facebook and Google and some others to show the new sort of economy that we're in. So if you look at infotech and consumer services, that's 30% of the index. So if you look at a day like Monday, when there were regulatory pressures coming out on privacy issues regarding Google and Facebook, and you had those companies sell off pretty big, if you looked at the overall market, the other companies in other sectors were actually doing quite well. So the index was held back because of those two sectors. Very much like in 2017 and much of 2018, technology and the FANG stocks, Facebook, Alphabet, Amazon, Netflix, and Apple really drove, and plus Microsoft, which doesn't fit nicely into the acronym, drove the market higher. It was really a handful of stocks that have been leading the market higher. So this is a problem because, if you have a sell-off in tech and you just own an index fund, the market could sell off. So what we try to do is equally weight the sectors, so we avoid this type of concentration risk as you see within the index. All right, and so we're going to go through within these sectors now where we think there's certain opportunities for the long term. The first one is healthcare. Healthcare has been the worst performing sector year to date, with a market that's up double digits. Why is that? The regulatory spotlight on the healthcare sector has grown tremendously. Here's a chart going back the past 10 years of the healthcare sector. And what you can see for here is coming out of Obamacare, healthcare was actually the best performing sector year over year. Look at that. Look at that chart. And then right here, August of 2015, a couple of things happen. Hillary Clinton fires the shot heard around the healthcare world and says we're going after regulation on drug prices. Part of that was because of nefarious things done by people like Martin Shkreli, who were taking drugs and ramping up, orphan drugs and ramping up like 4,000%. And then you had companies like Valiant, who were doing similar things at that time, and the entire sector really imploded. And you haven't seen much of a change since then. I mean, healthcare has gone up, but it has been an underperformer relative to the overall market. And President Trump has been pretty clear in terms of his desire to rein in drug prices as well. He's hearing a lot of feedback from his constituency that drug prices are just too high. Well, that's the short-term volatility. But if you look longer term, there are two trends that are not stopping. The population is growing and it's getting older. We're all living older, which means for a longer part of our life, we're going to be relying on the healthcare system more so than ever. And more people are going to do that. That's going to put more utilization on the healthcare system. And if you look at balance sheets and valuations of the healthcare sector, they're very healthy. They're very cheap. Valuations are cheap. As I mentioned, the healthcare sector is the worst performing sector year to date on a relative basis. And healthcare stocks in general have more cash only to technology overseas or cash on their balance sheet than any other sector. And they put that cash to work. If you look at the healthcare sector, they're buying back a ton of stock. By and large, they pay out a lot of dividends. They have good dividend yields. So this long-term thesis of an aging and growing population is not slowing down. And we think in an environment where we don't think it makes sense to buy an index fund and just broad base the overall market, we think healthcare is attractive. Now, again, every bull case comes with some bear case. If there is continued regulation on drug prices, that's going to be a dark cloud over the entire sector. If the U.S. does look to move to a single payer system, the healthcare insurance stocks like United Health and Cigna and Humana are large constituents within the healthcare sector. That's going to put pressure on that portion of the sector. And obviously, you're seeing, which is getting a lot of headwind, is the opioid epidemic that the country faces. Litigation is rolling out for some companies like some Purdue Pharma are basically about to file for bankruptcy, and you're seeing a tremendous amount of pressure on companies that have been announced or involved in that situation. The second sector that we like is financials, and particularly the banks. So the banks have been regulated to a degree almost like utilities, in the sense that every year they're stress tested by the Fed. They're required to have a certain amount of capital on their balance sheets. I mean, the government basically does not want a repeat of what we saw through 2006 and 2008. And that has worked. The banks are flush with capital. They're now at a point where, and over the past couple of years, where with the US economy being healthy and people taking on loans, they're lending and they're returning excess cash to shareholders. Dividends are growing and they're buying back stocks. So the banks are starting to get back to their old ways, at least from a reason of why shareholders like them. There is a trend too that we think is going to continue to emerge, and that is the U.S. is overbanked. There are thousands of banks in the U.S. and it's just not necessary. Earlier in the year, BB&T merged with SunTrust, and they took two large regional banks and formed, I think, what's the sixth largest bank now in the U.S. between the merger. And this could lead to further consolidation within the bank sector. Banks are moving away from traditional brick and mortar. You're seeing more banking done online. If you don't have to open a storefront for a bank, that's just going to help your margins, and it's going to help your the less amount of money that you put out from cash flow that could be returned to shareholders or put in for growth for growth profile. Banks have diversified a lot more today than they were over the last 10 or 20 years. And they're no longer just traditional banks of offering savings and lending. Most banks, particularly large banks, have a wealth management unit. They have investment banking. They have a trading division. So their revenue streams of the larger banks are significantly more diversified today than at other points in history. Loan demand, as I mentioned earlier, is solid. Although interest rates have ticked up over the past year or so, by and large, there's an appetite. As long as the unemployment rate remains low, people have jobs, they're going to take out loans. And as a portion of overall assets and loans, non-performing loans are still really low when the banks report quarterly. So this is all a good sign and valuations are really attractive. Most banks are trading at or around their tangible book value. So you're not getting, to put that in perspective, in 2006, the banks were trading at about 2 times their tangible book value to 2.5 times. So you're trading at a big discount to where banks have historically traded, and we think there's value to be had there. Again, there are near-term risks. An inversion of the yield curve. So what does this mean? Traditionally, the way the banks make their money is through their net interest margin. It's what does the bank charge you for your 30-year fixed mortgage, right, the loan, versus what do they pay you for the CD that you're taking out, the 1 or 2 year CD. And right now, as you're well aware, yields on loans have come down and CD rates are pretty high. So if the bank last year was paying you 2% for your 5-year CD, but they were charging you 3.5% on your 5-year loan, the bank made the 1.5% spread. Well, this year, if the bank is paying you 2% on your CD and they're charging you 2.5% on your 5-year loan, they're only making a 50 basis point spread. So the flatter the yield curve, the worse that it is for the banks. And if we get to an inverted yield curve, that's going to pressure the banks' profitability in the near term. And technology, obviously, as we move away from brick and mortar, more investment into things like blockchain and technology could pressure profitability. But again, that's in a prolonged yield curve environment. So we like healthcare and we like banks. The last sector that we think is attractive is international. There's a little bit of the valuation gap between the S&P 500 U.S. domestic stocks. Remember, there are no international-based companies in the S&P 500 versus an international index is really wide. And why is that? Well, the global economy is really driven by what China does. And with the Chinese economy slowing and tariffs pressuring that, there's a lot of fear that the global economy is going to slow and international stocks are going to have a hard time. Plus, because the U.S. economy has been the best house on the worst block, and prior to this year, with the Federal Reserve raising interest rates, the U.S. dollar has strengthened. And if the dollar strengthens, investors will pour more money into U.S.-based stocks and not international stocks. But that's not going to last forever. Okay, with the amount of debt that the U.S. has, with the $21 trillion in debt, at some point in time, the dollar is just not going to be that strong. And if the Federal Reserve cuts interest rates, and we see some reprieve on tariffs, you should see a re-rate of valuation back into international stocks. Particularly emerging market and in the developing economies, their populations are still growing and they're still very underdeveloped from an infrastructure standpoint. Part of the interesting unintended result from tariffs could be if companies move their operations and their manufacturing out of China, and they go to places like Indonesia and Vietnam and Malaysia and Thailand, that's only going to add more funds to those countries who are going to have to invest in more infrastructure like airplanes and roads and rails, and you can see the wheel just begin to turn for those types of economies. They're still very underdeveloped. There's been a trend for the past 20 years of people moving from the rural class to the middle class as the economy has moved. And more developing countries have grown at pretty high growth rates over the past 20 years. Their population has moved from a subsistence economy out of the rural class and have moved into the bigger cities to get higher paying jobs, to get better educated. And that movement into the middle class and that population growth is only going to drive GDP growth further for developing countries. So again, longer term, we still think that is very attractive. Again, look at the U.S. population is slowing. If there is more draconian rules on immigration, that's going to slow U.S. population growth. Population growth plus output is what drives GDP. So the demographics are still very favorable for global growth for foreign countries. And by the way, global central banks are in a quantitative easing mode. Reports today came out that the Chinese may do more stimulus. The Japanese continue to stimulate their economy by keeping the yen very low, interest rates very low. And if Italy continues to sour, you're going to see the ECB go back into the bond market and do more quantitative easing there. Again, all of that pushes investors out the risk curve to buy stocks. Now, this doesn't mean, as I mentioned in my past comments, that there are a lot of risks to the international market. Trade wars between the U.S. and China, now with Mexico, are a concern. The thought that if China sneezes, the world, maybe ex the United States, catches a cold. That holds true. China is such a big demand of the global economy. It's 15% of the global economy, and they report growing at 6.5%. But you have to hold their numbers a little bit of a grain of salt. But the rest of the global economy feeds off of China's growth, and if China's growth is slowing, then that could mean that the global economy is slowing. And obviously, I've mentioned the concerns on the European Union. But my point is, for longer term, the trend and the demographics still favor international stocks, and I do believe that valuations are attractive relative to domestic stocks. Remember, it wasn't too long ago that BRIC, Brazil, Russia, India, Indonesia, and China was the big acronym, and people were tripping over themselves to have exposure to those countries. Well, they may not be growing as fast, but the growth demographics and the movement to the middle class is still very relevant. So that's the end of the formal presentation. We'll move to Q&A. So if you have any questions, please add it. Please go to the chat room. Let's see how we're doing on our poll. So again, nothing's changed on the poll. Still 2/3 of you think that the U.S. is heading into recession in the next 12 months. A third say no. We always put this up. This is how you could reach out to us. As I mentioned, this is our contact information. If you have questions regarding the webinar, please feel free to reach out to us. Give us a call. If you want us to review your portfolio and your current financial situation, we'd be happy to sit down with you for a complimentary meeting. If you think there are others within your family or friends that could benefit from this, that may need some, a second pair of eyes in their situation, we'd be happy to meet with them. So let's go to, I'm going to ask Elaine to join back in, and let's go to the Q&A section of the webinar. I'll give you a couple seconds here for the queue to line up. Okay, here's one question, obviously very topical. What are your thoughts on the outcome of the tariff situation? Well, I think the tariff situation with China is going to be here for a very long time. I don't think you could put the genie back into the bottle on the situation. And what I think we hope for is that the US and the Chinese each take one step backward, meaning the US comes off and either lowers, they come to some resolution where the US either lowers the tax rate on the goods that it's tariffing, that it's putting a tariff on, and or it lowers the dollar amount. So maybe instead of putting a tax on $200 billion of goods, maybe they lower it to $100 billion. Same thing with the Chinese. Instead of having $60 billion of U.S. goods taxed, maybe they lower it to $30 billion. So I'm hoping that each side takes one step backward, but this issue is not going away. So and we think we've been advising clients that don't trade or don't get overly excited about the tweets or the headlines or the hope that something may get resolved or it may not get resolved, or what has to happen now is we have to wait for the upcoming earnings season in July and see how companies are dealing with the rising costs to their business. Are they able to pass through customers? What are the contingency plans? Will they move production out of China? So on and so forth. So we do think politically that this will come to an end, particularly before next year's election season. But we're not basing any of our decisions on hope that it will come to an end. You have to wait and see, and we continue to focus on diversifying our clients' assets because, again, you just don't know what the future holds. That's why we spread out risk like we do. That's why we have an allocation of gold for clients. That's why we do invest in some fixed income. Elaine, here's a question for you. With yields so low, why invest in bonds today, right? Why buy the 10-year at 2.2%? What purpose does that have in a portfolio?
Well, bonds for us are obviously part of the diversification of the portfolio. So while the yields might not look terribly attractive, at times they do provide kind of stability. The volatility of bonds will not be as great as that of stocks. So should the stock market swing and you could pick up a 10% correction, historically bonds have not moved that much. So we look at it as you do collect the interest payments, but you also have stability to the portfolio should the equity market swing. So there's a place for bonds in your portfolio.
Great. Last question that I see here is, given that tech is such a large sector of the S&P 500, should my portfolio have that much exposure to tech as well? Elaine, if you want to jump in, feel free, but I'll take this one. The S&P 500 and most index ETFs are market cap weighted, which means the larger the company, the larger their weight in the S&P 500. So for example, Microsoft is the largest market cap company in the S&P 500, and it's got a 4% weight in the S&P. Apple is one of the largest companies, and it's got a 3.3% weight in the S&P. Facebook is the third or fourth largest. So, how do you get a larger market cap? Your stock price rises. And usually that means that your valuation is higher, and law of large numbers kicks in, and it's harder to grow when you're a larger part of the overall index. To put this in context, in 1999, tech and telecom combined were nearly 40% of the S&P 500. And we all know where valuations were on those sectors in 1999. In 2006, banks were, in 2007, banks were about 20 to 22% of the S&P 500. Right now, or financials, financials are 13.3%. Think of where energy was as a sector weighting in 2008 when oil hit $147 a barrel. Now energy's 5.2%. So don't chase a sector weighting in your portfolio just because that's how it is, because you want to mirror the index. We definitely don't manage our clients' money that way. Again, we take a neutral approach to sector weighting by equally weighting the larger sectors at about 10%, and then the smaller sectors like utilities, real estate, basic materials at about a 5% weighting in the portfolio. All right, so we try to take a horizontal approach rather than making a thematic bet on any one sector. All right, well, I don't see any more questions. Thank you so much for your time today. We'll send all of you a replay of this webinar, and be on the lookout. We'll have another webinar coming up in July, and we're doing this once a month. We're trying to test different times. Typically, we've done some webinars around 3 o'clock. This one we tried in the morning. So we're trying to see what's the best and most optimal time for you. And again, if you can't make a webinar live, register anyway, and we'll send you the replay. Thanks, everybody, for your time. We really appreciate it.